Yo, what's up, you guys? Welcome back to a new midweek market update. And what crazy news just pulled through for the dollar index, as if things were not bad enough as they were before. Unfortunately, the CPI reading came through lower than anticipated, and because of this, obviously gave the dollar a dive for its money. Now, if you probably wondering how and why is this all taking place, please make sure that you stay till the end of this video. Now, if you're new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you do enjoy the content, please do consider smashing that thumbs up button, and let's get this video to at least 100 likes, my good friend. Now, first thing, article from CNBC came through and says Dow jumps more than 200 points after lighter than expected inflation. Now, I'll give you a simple explanation. This is what happens when inflation is on the rise, right? Because of this, when inflation goes up, the Feds then step in to hike interest rates. Higher interest rates then give us a stronger dollar. Now, when inflation starts to tame down, the Feds are less likely to hike the interest rates. And because of that, investors go, you know what, we're not interested in putting our money here anymore because you're not giving us the kind of rates that we are looking for. To give you an even simple example, let's say, for instance, this nail clipper that you have over here, right? This nail clipper is currently selling on the market for 50 Rand. And you are an investor and you see the potential of this nail clipper going to $100 because I come and I speak about this nail clipper every day. The only reason why you're investing is because I'm speaking about it, and because of that, the value of the nail clipper increases. One day I make a video and I say, guys, I do not want to speak about this nail clipper anymore. And because you're an investor, you automatically goes, okay, then I'm not interested in investing in here anymore, because the main reason why I invested was because I was speaking about it. The main reason why people invest in currencies is because of higher interest rate. Now, when the Feds came through basically and said, ooh, inflation is cooling down, we don't have to hike interest rates any longer, what do we have now? We see a weaker dollar, and the price is only about to start to move to the downside. As I said, we do expect a 90 over here somewhere there, because that's pre-pandemic levels, basically where everything had started before the massive move for the index to the upside. It was right at this level over there, and you can see right here is where we expect the market to further dive a little deeper. But for now, we're going to focus on 99 because it is the previous structural level that the market had created. It says here, US stocks jump on Wednesday as traders cheered new data that showed inflation rose less than expected last month. So again, the reason why you get a weaker dollar when inflation becomes lower, that's basically inflation is directly tied to interest rate decisions. And investors invest in a currency when the interest rate goes up. Interest rate will only go up when there is a increase in inflation. So now that they know inflation is starting to cool down, they know that inflation is cooling down and the Fed is less likely to hike the rates. So they go, we're not interested in doing this anymore. Now, if you're sitting there wondering, okay, but why is the price of the stock market increasing? Well, my friends, you are in for a treat. The reason because of that is simple. So basically what happened is there's something called the Consumer Spending Index, which is what we received today. And this is a main indicator that's used to measure inflation in the market. So basically what happens is that when the Feds came in and they hike the interest rates, what does high interest rates do? It puts strain on your budget, right? That means you are less likely to spend money. Now, if you've ever taken a list, or if you've ever taken note of the companies that are listed on the NASDAQ, these are a lot of tech companies, right? The S&P 500, the NASDAQ, they all consist of companies. Now, if consumers are not spending as much because of the the interest rates being so high. So when interest rates are high, consumers can't spend, because the reason why the Feds are hiking interest rates is to discourage consumers to spend so that inflation can come down. Now, because consumers are spending less because of high interest rates, you see a normally market that would potentially move to the downside. Now, keep in mind, this is a monthly candle. We're going to go down on the daily, and I want you to see the differences between these two so that you can see kind of see exactly what it is that I'm talking about. Now, you see this move over here is basically this move that you see over here. So when the index was bullish, the stock market was bearish. There you have it, right? And the reason for this is because of higher interest rates, consumers are discouraged to spend because they don't have any more money. And because of that, because tech companies are made up of companies that generate revenue through consumer spending, if consumers are not spending, then they're not making any money. And because of this, they take a heavy knock, and we see the bearish price action that had taken place. Now, you can see what is now happening, which is vice versa. What we have over here now is you've got a massive bearish dollar index. Why? Because ever since there were signs of inflation cooling down, that means that the Feds are less likely to hike the interest rates, even more likely to decrease the interest rates. This encourages consumers to spend their money on the top tech companies or on the companies that are listed on the NASDAQ. And because of this, we can see over here, we have a massive bullish price action. And that was your news lesson for the day. Let's continue. So basically what it says here, then Dow Jones was up 0.8%, the S&P was up 1%, and the NASDAQ was up 1.4%. S&P was there at about reached a new high for 2023, and it's a level higher than what it was in 2022, which is very amazing to see. That the stock market is recovering, because I remember back in February, a lot of investors were coming out saying that we don't know if the stock market's going to survive this week, and we had all of that stuff going on there as well. But we do have some core PPI coming through there as well, month over month, and PPI month over month coming through there as well. But the most important thing for us to look forward to now is going to be, after this information, is going to be on the 26th of July, which is going to be the Federal Reserve interest rate hike. Now, keep in mind, as it stands now, investors expect the Feds do not hike their interest rates. Why? Because there is some signs of a cooling down in inflation. Inflation's cooling down. There's no reason to hike the interest rates. They still are not at their target, but there is no reason. And because of this, we can expect this market, the stock market, to continue this bullish momentum and go back to where we once was at last year, January, just before the Feds started coming through with those interest rate hikes as well. Now, before I get onto the technical analysis, I want to go through some of the questions, if there is any. Mr. Duke is saying, I'm learned. Is it my screen? Yep, there we go. I'm learned from you, not only trading, but so much a life skill. Thank you so much, guys. One thing I want to tell you guys, right? If you want to become good at trading, you shouldn't do it because of money. You should have an actual passion for trading. Because why? If you don't have a passion for this and you only want to make money out of the market, then you're not going to put in the effort. So if you genuinely want to become good at trading, make sure that you have an actual desire to want to understand how the market works. And I always tell people, right? I always say to people that most guys that you see on Instagram, for instance, right? They're living the best lifestyle that they could ever live, that you can ever find. But trading has become kind of a lifestyle now. Now, for me, for a lot of people, that's freedom. For me, that's not really freedom, right? Freedom for me is, having been able to make maybe, some money to be able to pay the rent at the end of the month. And that for me is good enough. I can't flex a lifestyle because you can see behind me, this is a 1 bedroom flat. My rent is very low, so it's probably less than what most of you guys are paying. So I can't do a video where the day in the life of a trader, stuff like that. I unfortunately can't do that, and I'm not gonna fake it by going to a fancy hotel and then start shooting videos over there. No, I'm not gonna do it, because I don't build my success upon other people's failures. So I don't take people's money and make my life look lavish or anything like that. So it's unfortunate that you can look through me and see trading is not as easy. I see a lot of people look up to people that's got nice cars, but that taught them nothing about trading. People that doesn't even do these kind of videos for you guys, but this because these guys are driving fancy cars and they posting fancy houses, and this is the kind of guys that normally takes your money and they fly to Dubai, that kind of just rhyme. But these are normally the kind of people that I hear people go like, oh my god, you a goat. I saw another person who said, oh my god, it was such a big pleasure to meet you, Mr. Whoever the case. I'm like, wow, you actually think it's an honor to meet this person. These people are not, they're not making an impact on your life. It looks good, it looks beautiful, but I can tell you today, it is not that easy. It's very easy to make people believe. That's why I say trading on Instagram is not trading. It's become more of a lifestyle now, and people just keep building on that, and they sell, and they build on that, and they sell. So if you ever expect me to do a video the day in the life of a trader, unfortunately I can't. This is a 1 bedroom flat. It's not gonna work. I can't do like day in the life of a trader, wearing Gucci's, and I can't, I don't have that kind of money, unfortunately. So that's why I say trading is more of, you need to have a passion for this, and thank you for this, and by adding so much of a life skill there, so much skills in life there as well, and I hope some of you can actually take away something from this as well, because a lot of people think this is easy. Sorry, it's not. It is not easy. It is not a job that requires hard labor where you have to pick up 20 pallets, but psychologically and mentally it becomes draining, and it's easier to sell something to someone than it is to trade. It's difficult to trade the market because there's a lot of emotions involved. So why does people want to go through the hassle of doing that, where they could just make you believe that they can do it and then just sell you something, and you later on question that thing, say, hey, but you were buying Ferraris, why can't I buy a Ferrari? You understand? And I always look at these guys and I think to myself, most of these guys drive cars that cost more than that cost more than my entire life. And I think to myself, wow, you've done this, and you haven't done anything for any person. Yet there's no testimonials to say that you've actually done, to help someone there out there as well. But let's move along, my good friends. It says here, Mr. Rowley, I've been watching your educational content for some time, for some while, and I analyzed before I watch. Sorry guys, let me just go back there. And I analyze before I watch the market breakdown, but I always anticipate the opposite. One thing I want you guys to remember over here, there's no such thing as being right or wrong, because sometimes I'm also on the wrong side of the market. That is why I always say you have to take the information that I provide you with a pinch of salt, and then obviously add the rules of the strategy that you use, meaning that when I'm wrong, you're right, and when you're right, I'm wrong. So that shows you the probability that the easy in trading, you're not always going to be right. And you shouldn't always expect to be right. If your analysis is different from mine, then maybe you're right, because maybe now I'm wrong, and then that means you're right. So that's basically how it works. We can't always be right. If we were always right in the market, then a lot of us would be doing this now, but we can't. It is too much, my friends. Okay, so don't aim for always wanting to be right, but aim to be right more than you are wrong. Mr. Nietling is saying, how do I get in contact with you legitimately? LOL. All these fake accounts, I'm not sure who and where to message anymore. Website is still down. Yes, you can just drop a message here on YouTube comments if you need anything for me to check out for you. Now this is proper investigation. Thank you so much. Thank you for that. Can you please look at Euro AUD? Okay, I will open it up here and just go through the questions, and then I will come back to answer this one to look at this view quickly. Where are we now? Were you FBI, CP, CIA become? No. No, I was not anything like that. Donkey, LOL, genius. Thank you. Analyze binary indices. No, I don't. But you're probably referring to what are these things called? VIX75 and all of that stuff. If you need me to have a look at one of those, I'm more than happy to go on to binary.com and do a breakdown for you on there. So just let me know. Scammers are funny. I'm the 10th viewer. Fire. Thank you. Cheers for the ears. Thanks. Yes, scammers are one of the funniest people that you're going to find, and also the most frustrating people that you can find, right? The thing is, if you scam people, firstly, and you get called out for scamming someone, you have to own that. The problem with a lot of people nowadays is that they scam people, but if you tell them you're a scammer because of X, Y, and Z, then they become aggressive and they want to come for you and they want to come at you and they want to be a keyboard warriors. You don't do talk stuff, but you're doing it, like you're doing the wrong thing. Why is it so difficult for you to understand? And yes, they are funny because even if you show them the proof, there you're scamming people. They will still come back and say, yeah, but you're gonna see what I'm gonna do. Don't threaten me, please. Like don't do something wrong and then you want to threaten me. I'm not saying anybody threaten me. I'm just saying don't do wrong to the people and then you want to threaten the people after there as well. Okay, let's look at Euro AUD and then we go over to that. So basically what I can see from the price action that is being developed at the moment, we obviously have the market that had broken, had created the resistance, broke above resistance, support clearly didn't hold, and this was obviously one of those market manipulation, because if we do go a little bit deeper, we can obviously see over here we had this fake rejection there, giving the retail traders their anticipation that we might potentially go higher. Alternatively, what we have now is a potential head and shoulders pattern. Now, a head and shoulders pattern is normally considered a bearish pattern from a technical perspective, and this is basically what I suggest you would wait for. The market also printed a massive impulse. After an impulse, you obviously expect a correction, and the best way to measure that correction is by taking your Fibonacci from the high to the low of the impulse, which is the red candle to the red candle. Now, we can also see here we've got a 61.8, which is known as the big gold ratio, lining up perfectly with this previous structure. This will also act as the right shoulder of the head and shoulders pattern that we are looking to anticipate at the also in the meanwhile. So about that, so please make sure that you do apply the rules of the strategy that you use. I would probably wait for a pullback first and then look for that continuation to the downside for the market to come and hit this previous level of support. Next up, we're going to start with the index, right? So the index is obviously melting to the downside, and this meltdown to the downside is not going to continue like a lot of people would. The reason why I say so is because the market had just broken above very strong daily support. Right now, this is obviously where a lot of liquidity is here. Now, we obviously know the market also moves in waves, so the market's not going to go like this. The market's not going to pull a Japan yen on us, so I definitely expect a pullback. Here we also had a gap that the market had fell open to. Sorry about that. So we're going to clear the chart here on the lower time frame. So we obviously have this gap that the market needs to come and complete first also. And then if we go back down on the daily time frame, what do we have? Firstly, we can see here we've got a market that has just broken below this very most recent support. Now once support gets broken, we obviously know it becomes resistance, so we obviously expect a pullback. We also have the market that is about to break below support, but this is obviously a high liquidity area over here. This is where a lot of retail traders had put their stop losses, for these orders that they have here. Also, a lot of retail traders came in there to buy because they use simple price action movements there as well. Now we have a massive impulse. After an impulse, you expect a correction, and if you take your Fibonacci from the high to the low, once again you can see I'm taking it from the high to the low of this red candle. We can see the gap that we have over here is lining up perfectly with the 0.382. Do I expect the dollar index to weaken in the long term? Yes, I do. 100%. I do agree that it continues lower in the long term, but I do expect the market to pull back first, then continue to the upside. Gold pull back and then continue to the upside. Gold had just completed what's known as a W formation. Now obviously after a W formation, you expect to pull back to the neckline. We also have this massive impulse. So after an impulse, you expect a correction, and the best way to measure that correction is by taking your Fibonacci from the low to the high of this massive impulse. And what we have over here is we got another 61.8 that's lining up perfectly with not only the neckline of the W formation, but also a previous level of resistance that is now turned support. Now, the best way to obviously approach this is to wait for the market momentum to start shifting bearish. As we can see, we are quite bullish over here, and then definitely start looking for that selling opportunities for the market to move to the downside, then hit the neckline of the W formation and also the previous level of resistance that is now turned support there as well. We've got the NASDAQ 100 very bullish that we can see over here. If we go down on a daily time frame, what do we have over here? Now, from a daily perspective, we can clearly see this is the next structural level that we can expect the NASDAQ to continue higher to. This level over here acted as resistance, support. The market broke back, and we can definitely expect the market to come back, hit that level, and then continue higher. Now, from a daily perspective, what do we have? Now, what we can see over here is that the market was obviously in a consolidation, awaiting the CPI data. This is the consolidation phase that I'm referring to. We just got to break above that level. Best way to do this is to wait for a clear daily close above this level. On the pullback, we can expect that continuation to the upside. And if you take your Fibonacci from the low to the high, just to see if we are going higher, there is a potential, of us going slightly higher and then pull back there as well. We can always discuss the next move when we get there, because sometimes I feel like I'm giving you guys too much too soon. I'm giving moves that in the first move did not even take place yet as well. I'm gonna remove this the GER30 from the watch list, because this is basically, as I see now, this is basically all I expect. This is massive market manipulation as well. Next up, we've got the Dow Jones. The Dow Jones is basically back at this level, and I do not think it's gonna back down this time around. And the reason why I say so is that this market, basically, if you go slightly left, right, and you take this level here, you can see how many times the market printed resistance, liquidity, and liquidity. Now the market is no more liquidity. So we finally broke above this previous level of resistance, and all of that resistance is now turned support, right? We have a massive impulse. So after the impulse, we need a correction. And if you take your Fibonacci from the low to the high, now a good trick that you can learn over here is always move your Fibonacci to where the 0.382 lines up with the previous structure, and wherever the Fibonacci basically ends, which is there, that's where you can expect the market to continue higher to before start pulling back, because the 0.382 is the first Fibonacci level that needs to line up with structure in order for us to get a proper confirmation of where the market's supposed to turn back to. That's all from my side. Thank you for your time, and as always, cheers for ears.